prices going up simply represent the value of your money going down. And that increase is a tax. It is the inflation tax. And as long as government spending is not being cut, the inflation tax is going to keep going up.
Are we on the brink of a global economic shutdown? Well, maybe it's not that bad, but the financial forecast hasn't been looking too good. But now, we're worried about the impending economic storms as predicted by the finance guru Peter Schiff. Peter Schiff has been sounding the alarm about inflation, but just how bad can it get? Let's find out. But first, who is Peter Schiff? Peter Schiff is like the financial soothsayer, always warning us about the storms on the horizon. He's got this unique knack for spotting economic turbulence before it hits mainstream news. He's not your typical Wall Street guy. No, he's the founder and chairman of Euro-Pacific Capital Inc., a financial advisory firm. Schiff's ideas and predictions often swim against the current, and he's a firm believer in limited government intervention in the market. He's also a strong advocate for investing in precious metals like gold and silver.
Nobody who makes under $400,000 a year is going to pay for it. He's lying, because everybody who makes under $4,000 a year, $100,000 a year, is paying the inflation tax. Because when the government spends money it doesn't have, the Fed prints it. And when that money gets printed, everybody's money is worth less.
Now that's a tune you might not hear from every financial expert out there. But here's the thing, and why you should pay attention to what he's saying. For starters, he makes some really compelling arguments. And remember, it's always good to consider multiple perspectives in the finance game. One of Schiff's most notable claims to fame was predicting the 2008 housing market crash before it happened. That's like predicting the plot twist in a thriller before you even spot the climax. It's earned him some street cred in the finance world, and rightly so. Now, as we fast forward to today, Peter Schiff has been vocal about his concerns regarding the current state of the global economy. He's been raising red flags about debt levels, inflation, and the overall stability of the financial system. Again, whether you agree or not, it's valuable to listen and learn. Inflation. An unhealthy rise in inflation is Schiff's first argument. You've probably heard this term tossed around a lot lately, especially in the context of Peter Schiff's warning. First off, what exactly is inflation? Think of it as the steady rise in prices for goods and services, making your dollar less powerful over time. Now, how does this tie into the stock market and Peter Schiff's red flags? Well, here's the scoop. Inflation can be influenced by various factors, one of them being the Federal Reserve, often fondly called the Fed. The Fed's policies, particularly on interest rates, play a massive role in controlling inflation. When the Fed lowers interest rates, borrowing becomes cheaper, encouraging people to spend more. This boosts demand and often leads to higher prices, which is one of the drivers of inflation.
You got a big rise in the dollar on foreign exchange markets because speculators were bidding up the dollar based on the Fed rate hikes. Well, the dollar rally is over, and there's not that much oil left in the reserve anymore. So I think that's why oil prices are up about 30%.
Now, let's connect the dots. Peter Schiff has been cautioning about inflation for a while, and he's not alone in this. The Fed's measures to combat the economic fallout of the pandemic included keeping interest rates historically low. This was aimed at stimulating spending and investment. However, this also opened the door for potential inflationary pressures. When inflation rises, it can affect the stock market in various ways. Imagine you're holding shares in a company. If that company's costs increase due to higher prices for raw materials or wages, their profits would take a hit. In turn, this might lead to a drop in the stock price because investors expect a certain level of profit. Moreover, inflation erodes the purchasing power of consumers. As prices for everyday goods go up, people might cut back on spending, impacting businesses and consequently their stock performance. It's like a domino effect. You push one piece and the rest start to fall. Let's crunch some numbers to drive this home. In recent times, the annual inflation rate in the U.S. has surged. As of August 2021, it stood at 5.3%, the highest since 2008, according to the U.S. Bureau of Labor Statistics. Now, when inflation is on the rise, it can spook the stock market. Investors might start worrying about the future value of their investments in an inflationary environment. In response to this, you might observe shifts in the market. Investors often look for inflation-resistant assets during these times, like gold or real estate. Peter Schiff is a big advocate for gold as a hedge against inflation. Why? Historically, gold has maintained its value and acted as a safeguard when currencies lose value due to inflation.
People can't afford to buy homes, especially when the prices are still near the record highs. So if you can't afford to buy, you're stuck renting, and the landlords know this, so they have the ability to raise rents because their tenants don't have the alternative of, a 3.5% mortgage anymore.
In a nutshell, inflation isn't just a buzzword. It's a real force that can impact the stock market. Peter Schiff's warning about the potential inflation storm on the horizon is therefore not to be taken lightly. Economy. Economist Peter Schiff is pretty worried about the economy. He's saying that 2023 and the years after might be rougher than what we've seen before. The stock market, US dollar, and businesses might take quite a hit. 2023 seems like it's shaping up to be a dicey year for the stock market and the good old US dollar. People in the know think the US dollar might have one of its worst years in a long time. Things are getting even trickier with falling asset prices, making the whole market all jittery. Peter Schiff thinks this could push us closer to a big financial crisis. In his crystal ball, 2023 doesn't look great in terms of market performance. Inflation might rise significantly, making people and businesses a bit more hesitant. Who knows, the U.S. Federal Reserve might take a dip too. Schiff predicts consumer prices will continue to rise. The national debt is skyrocketing, and guess what's rising right along with it? Prices. Prices of everything you can think of. It's like a never-ending escalator of expenses for the average Joe. You see, when the national debt climbs, the value of the dollar takes a nosedive. It's simple economics. More debt equals a weaker dollar, and that's bad news for the regular folks. Prices surge, interest rates climb, and it's us, the consumers, who have to deal with the fallout. The ripple effect hits businesses too. With their profits vanishing into thin air, they start tightening their budgets. That means pay cuts for employees, and nobody's happy about that. It's a vicious cycle. Less spending by businesses and consumers, less money sloshing around the economy. Peter Schiff's crystal ball isn't showing rainbows and butterflies. He doesn't foresee a magical drop in consumer prices anytime soon. The national debt is like a monster under the bed, and it's already grown past the 30 trillion mark. And guess what? It's not planning to stop growing. We're in for a wild ride. Oh, and thinking of financial moves, Schiff thinks Bitcoin's a decent option. But hey, it's not the only fish in the sea when it comes to investing. We all have different options to look at. Still watching? Hey, you'd probably like our other videos. Subscribe to get more videos like this. The US dollar will continue to fall in 2023. You see those tiny gains it made in the last half of 2022? Poof, gone within the next quarter, according to Schiff. Compared to the last 10 years, the dollar's recent performance has been like a roller coaster. Down, down, down it goes. The US dollar index, a measure of its strength against other currencies, isn't exactly flexing its muscles. It's not as weak as during the Great Recession, but it's been on a steady decline since 2020. Schiff sat down for a chat with KITO TV, and he's adamant this trend won't reverse. Why? The national debt keeps piling up like a bad roommate who never pays rent. The government's throwing punches to keep the dollar from face planting.
People would be better off skipping college and just getting a job. If you want to learn, you got the internet. You got AI, you can teach yourself with the help of all this technology. You don't need these overpaid teachers unions and universities and all the money they're spending. The reason that the educational system got so bloated was because of government involvement. On the federal level, it was subsidized, guaranteed government loans, then direct government loans.
Recently nudging national interest rates up to 4.75%. It seems small, but in reality, it's the highest it's been in 16 years. To sum it up, our greenback's in a free fall, and unless Uncle Sam does some serious budget trimming, it's only going to get worse. Even if the government pulls off a financial miracle and tames the debt beast, we'll be wearing this financial black eye for quite some time. And guess what happens when the dollar takes a nosedive? The stock market plays follow the leader, and it's not a happy game. Schiff's betting the US dollar index might just plummet in response to the stock market doing its doom dance. We've got to brace ourselves because all signs point to a severe recession looming on the horizon. We will continue to see falling asset prices. Asset prices are on a downward spiral. Brace yourselves because this year might just go down as one of the global economy's worst, and the Western world might bear the brunt of it. Oh, and guess what? China might seize this dollar weakness to up their game. The stock market's in for a rough ride, struggling to shake off the blows from 2020 while facing fierce competition from other nations. That trophy for being the star of the economic stage? Well, it might just find a new home outside the U.S. The real estate market isn't throwing a party either. Mortgage rates are sky high, and real estate prices are playing limbo. See how low they can go. Uncle Sam keeps getting nudges to cut back on the spending, but it seems like the message isn't landing. Now, about that trusty savings account. Inflation's taken a bite out of it, leaving us all feeling the pinch. Homes, cars, stocks, they used to be like the Fort Knox of investments, but not anymore. Schiff's recommendation. Here's Peter Schiff's 2023 investment tip. Steer clear of debt and cozy up to precious metals. He's got a crystal ball, and it's flashing red for the economy. It's looking like a bumpy ride well into 2024. While inflation can significantly impact the value of currencies, it doesn't impact precious metals as much. The OECD estimates that Western economies in Europe and North America will continue to sharply decline in 2023 because of the Russia-Ukraine conflict. Oh, but this conflict isn't packing its bags anytime soon. It's like the unwanted guest overstaying their welcome, causing a ruckus in the global economy. And guess what? The U.S. economy's in the front row of this drama, feeling the heat from the international scene. So, it's important that we listen to Schiff's advice. We need to brace ourselves for a turbulent financial journey as rising inflation, falling asset prices, and a weakening U.S. dollar are on the horizon. Schiff's advice? Trim debt, invest in precious metals, and prepare for economic turbulence. I'll see you in the next video. Cheers.